Hello, and welcome to today's episode of NovaCast. Joining Jeff and I today on the podcast to provide an update on the markets and where things are headed is Brian Weisenberger, CFA and Senior Market Strategist, and also Executive Director with Kensington Asset Management. Quick timestamp for today. Today is August 7th of 2024. And I'm going to kick things off today by first welcoming you, Brian. Thanks for joining us and asking our first question here, which is, what were the drivers of the recent equity pullback that we've seen, and do you think it's going to continue?
Yeah, thank you, Elizabeth, and thanks for having me on. If you look at the market pullback, I think really, like most of the time, it wasn't just one thing, it was really a combination of things. And we've really seen equity markets pull back for just about 3 weeks. And I think that started first with a little bit of exhaustion from the AI trade. While we've seen earnings come in, I think strong, investors are seeing a little bit of increase or not seeing the increase in productivity and profitability yet from the investment that our companies are making in AI. And so I think in some regards, that was the initial catalyst for a little bit of the rotation and pullback, particularly in large caps. And then last week, you had a couple of weaker than expected economic data points that maybe raised some fears for recession. You had unemployment come in at 4.3%, which was higher than expected. You saw a weaker than expected manufacturing PMI. And so that really started to see some of the pullback on Thursday and Friday. And then really the large drop that we saw this past Monday was really much more of an acute situation, it seems, where it was really predicated on this Japanese yen carry trade, which for those not familiar was really just a situation where a number of investors, particularly hedge funds, had been engaging in this carry trade where they were borrowing money in Japan in yen because of the low interest rates and so low borrowing costs, and then converting those into US dollars to achieve a higher interest rate and essentially get the spread between those. And in some cases, even investing those dollars then into riskier assets, equity assets. And so last week on the 31st, we had the Bank of Japan raise their policy rate by 25 basis points. And that put a lot of pressure on these positions because it strengthened the yen and it required a lot of these investors to unwind positions. And so that led to a swift sell-off, a very large spike in volatility in the VIX, and I think a lot of concern from investors. The good news on that front, I think, is that that's not a fundamental issue. That's an acute unwinding of positions, and so not particularly concerning in the short term. But I also think it's really important to remember that drawdowns are normal. The first half of this year sort of, I think, maybe lulled us to sleep a little bit in remembering that the average drawdown in the S&P 500 within a year is typically about 14%. And we typically have 3+5% drawdowns in the average year. And so it's not uncommon to see these kinds of pullbacks, and it's not necessarily a sign of a larger issue. And in fact, sometimes it can be sort of a catalyst for blowing off a little bit of sentiment and then recalibrating for future growth.
Okay, great. So I guess that leads into the second question, but a little bit of maybe the answer that you just gave, which this isn't Kensington's first rodeo, right? So obviously we've had drawdowns in the past. So, what types of situations have you faced like this in the past, and how does the investment typically respond in those?
Yeah, it's a great question. We've been talking about this week, and I think the closest that we can sort of equate what's happened, at least this week with the large drop on Monday, was the Volmageddon crash that we had in February of 2018, which was sort of a catalyst from some specific trading done by some short volatility trading ETFs. And in our case, that's not really something that we're monitoring, are these short, very acute drops, because typically those types of drops have a corresponding rebound. They tend to flush out quickly. And as a company and as a strategist, we're really much more focused on longer term, more sustained drops in equity markets. That's really what we're trying to protect against. And so if you look at examples like COVID, like 2022, where you saw a little bit more of a sustained instances of market drawdown, where we tend to add more value because of our tactical nature. These shorter, more acute issues, we tend to move through them because they do tend to spike back pretty quickly.
All right, perfect. And then I've got one more question before I pass the torch over here to Jeff to finish us off here. So we talked a little bit about the equity markets and, kind of some of the pressure that's going on with them. What about fixed income, right? Where are we at with that for the year, and how is that looking going forward?
Yeah, we're really bullish on bonds for the remainder of this year. If you go back to the beginning of 2024, there was a lot of people out there that were really positioning 24 as the year of the bond. There was a lot of people that believed we were going to see a very strong year for fixed income throughout this year. And the truth is that didn't really materialize in the first half of the year. There was the expectation that we were going to see a significant number of rate cuts from the Federal Reserve. And when those expectations dissipated, the market kind of had to walk with some of that back. And so you ended the first half of the year with flat to negative returns in most fixed income categories. But the reason that we're optimistic from this point forward is that the circumstances that led so many people to be optimistic at the beginning of this year are still in place. You still have elevated yields where you can take advantage of higher coupons and clipping those coupons, which is something that we really haven't had the benefit of for a couple of decades. And now we have that expectation of Fed rate cuts moving into the second half of this year, and maybe a clearer path to that with Chairman Powell's comments recently. And so you have this great combination of the ability to take advantage of elevated yields, and then if and when rates do come down, you get the opportunity for some appreciation. So being able to make money in fixed income two different ways is really attractive, and we're really bullish for that in the second half of the year. But I would say that there are risks that exist, and you have to be cognizant of those, even in the fixed income category. We saw it in the first half of the year. If we get a surprise to the upside on inflation and the market has to walk back some expectations, that could be negative pressure. Certainly something that we're looking at is there are elevated levels of corporate bankruptcies. We've seen, last year about 635, which was in line with COVID. And before that, you'd have to go back almost 10 years. Through June, we've had 346 corporate bankruptcies. That's the highest there's ever been in the first 6 months of a year for the last 14 years. And so we do think the economy's strong, and I don't think that that's a major concern today, but it's something that we're certainly keeping an eye on. And I think when looking at fixed income, we do think a tactical approach could make sense, because there is a very large opportunity going ahead, but a tactical manager that can navigate some of that winding of the road, I think could really pay off.
Yeah, thanks so much for that, Brian. So as you can imagine, we've been getting a lot of questions about the election this year. So how have election years in the past impacted the markets, and do you see this one being any different?
Yeah, it's a great question. The first thing I would say is that it's not really part of our analysis. We are model driven in our strategies, and we're really evaluating price action in our target asset classes. And so we think ultimately everything filters through price. So it's not something that we're looking to project on, but we do like to look at historical patterns, to your point, Jeff, and see how has the market reacted historically in election year cycles. And I think that there is some pretty clear patterns that have presented themselves over time, particularly when you look at it on a month-to-month basis. And so if you look at it from this point forward, historically, August is a very strong month in election years, one of the strongest. And so, take aside the first week of this month where we've really seen some negative pricing pressure, historically, at least you would expect to see really positive asset movement in the equity asset class through August. And then where it gets a little more interesting is in September. That's typically a very weak month, not just in election years, but in all years, it tends to be a pretty weak month. And so we could see some weakness, presumably as people have a little bit of nervousness heading into the election, maybe some pullback, some profit taking. And then maybe most interestingly is that in our analysis, it doesn't really matter who wins in most regards. The incumbent, whichever party they're in, the challenger, coming out of an election in November, in December, you typically see a lot of strength into the end of the year. And presumably that's 51% of people voted for whoever won, and they're optimistic going forward. So that's the pattern that we've noticed. Now, obviously, we are in a heightened political environment. And so could it be different this year? Yeah, absolutely. Again, it's not something that we're going to take into consideration when deciding to be in or out of the market, but it may present an opportunity to tilt our portfolios one way or another to take advantage of some of those patterns.
Thanks so much. Heightened political environment is a great way to put it. So I know we talked about the volatility spike last week. How do you evaluate volatility as a part of your strategies?
Yeah, volatility is a huge part of what we do at Kensington. We think it's a really important aspect of evaluating an overall market. So I'd say a few things about it. One is, I think it's really important for people to understand that the VIX is not volatility. The VIX is a measure of the market's future expectation of volatility. And so when we're measuring volatility for purposes of our strategies, we're measuring actual volatility. We're measuring the speed at which the market is moving, how high and how low is the market going in terms of price action, because we think that's a good way of assessing inherent risk within the market. And so when we're measuring volatility, we want to see, again, how quick is the market moving, and then ultimately that's going to adjust our sensitivity to the marketplace. When volatility is elevated, it's going to make our systematic process more sensitive. It's going to make us more cautious, maybe pull in potential sell parameters, because we equate volatility to risk. And so while heightened volatility doesn't always lead to drawdown, in our evaluation, it does increase the likelihood of drawdown. And so we're going to be a little more sensitive and maybe a little more defensive in those situations to assess market vulnerability and then hopefully navigate it appropriately. But we think, in a systematic process, looking at price alone is not the full picture. You really do have to take into consideration the volatility environment you're in, and that's going to really inform how sensitive your overall trading process needs to be.
Sure. Thanks for that. So you can't turn on the TV nowadays without hearing about the Fed and what they're going to do. So what are your expectations for, the Fed and rate cuts for the remainder of the year? I know that they typically say one thing and maybe do something else. So what are your expectations?
Yeah, it's interesting. I think they say one thing and the market does something else. We sort of tend to take the policy of don't fight the Fed. We're inclined to believe that the Fed projection is what they're going to do until proven otherwise. And that's really served us well. I mean, if you look as an example, you go back to December of 2021, as we know, the Fed started raising rates in March of 2022, but Chairman Powell did start signaling that this might be something to expect all the way back in December of 2021. At that time, we decided, we're going to not take allocations in treasuries when we're, defensively positioned, which is something that we had historically done. We felt like the possibility of rate hikes was going to be something that was going to put negative pricing pressure on treasuries. And so we were allocating to cash, which certainly proved us well. And we're going to be inclined to take that similar process. And so if you fast forward to today, the Fed is still forecasting one cut for the remainder of this year. Now, the market is pricing in closer to 4 cuts. Earlier this week, there were people calling for emergency rate cuts in response to what the price action that we saw on Monday. Now, I think the most likely scenario is that we certainly will see a rate cut in September. Chairman Powell signaled as much in his last meeting. And then I think they've proven to be pretty data dependent. And so I think they'll evaluate from there on future cuts going forward. And I think the real driving factor of that is going to be the probability of recession. If you look back historically in periods of rate cut environments, there's really been 2 paths that the Fed has taken. You can look at years like 95 or 98, where we were able to avoid recessionary environments. And in those cases, the Fed cut 1 or 2 times. That allowed them to be more restrictive because there wasn't the pressure from a weakening economy. Now, if you take the flip side of that in a situation like 2001 or 2007, where we did face recessionary environments, the Fed was much more aggressive, 4 or 5 cuts in those instances. And I think the driving factor of that is that very often we think that rate cuts drive recession, but in reality, rate cuts typically come in response to recession. So I think one cut in September is very likely, and then it's really going to be dependent on how strong can the economy continue to move forward. If it does weaken significantly, then I think the Fed is going to get a lot more aggressive, but I think it's going to be very data dependent.
Ryan, thanks so much for spending some time with us today. I know that a lot of these questions have been on our clients' minds, so we hope that those who are listening provided a little clarity, as far as Kensington's investment approach and as a part of your overall plan with Nova Wealth. So if you have any follow-up questions, please don't hesitate to reach out to us and schedule a quick call using our Calendly link. Thanks again, Brian, and go Bills.
Thanks.
Thank you.